Let's turn to the economy. So substantial progress has been made on inflation since inflation peaked in 2022. And that peak was in the range of 7 to 9%, depending on how you measure it. The monthly inflation readings for January and February came in firmer than the readings over the second half of last year. The disinflation process won't be a smooth path back to 2%. Now, in my own view, I don't think the inflation picture has changed very much since the start of the year, because I'd already thought that the pace of disinflation would slow down this year. I continue to think the most likely scenario is that inflation will continue on a downward trajectory to 2% over time, but I need to see more data to raise my confidence. I don't expect I will have enough information by the time of the FOMC's next meeting to make that determination. So I've raised up my projection for growth for the year based on incoming economic information, including the official statistics. So in the most likely scenario, I still expect growth to moderate compared to last year's very rapid pace. But instead of the economy growing under trend this year, I now expect it to grow a bit above my 2% estimate of trend growth. I expect the labor market to continue to come into better balance this year, with a slight uptick in the unemployment rate from its current very low level. And I expect further progress on inflation, but at a slower pace than we saw last year. Now, if the economy evolves as expected, then in my view, it will be appropriate for the FOMC to begin reducing the Fed funds rate later this year as inflation continues on its downward path toward 2% and labor markets and economic growth remain solid. Now, these reductions should be viewed as a normalization of policy back to a neutral level as the economy returns to price stability and maximum employment. Now, I've been discussing my view of the most likely scenario, but there are several risks to the forecast, including continued heightened geopolitical tensions, slow growth of the Chinese economy, renewed stresses in financial markets, and on the upside, the possibility of stronger than expected productivity growth. Now, at its meeting 2 weeks ago, the FOMC decided to keep the target range for the Fed funds rate at 5.25% to 5.5%, and reiterated that it doesn't expect it will be appropriate to reduce the target range until the committee has gained greater confidence that inflation is moving sustainably toward 2%. At this point, I think the bigger risk would be to begin reducing the funds rate too early. And with labor markets and economic growth both being very solid, we do not need to take that risk. Now, our current monetary policy stance puts us in a good position for managing risks that can manifest themselves on either side. If labor markets deteriorate, we can move rates down sooner and more quickly than in our baseline. On the other hand, if inflation appears to be stalling at a level above our goal, we can hold our restrictive stance for longer than in the baseline.